You know it's important for future building wealth. But where do you even begin? It can feel super intimidating, especially when it seems like everyone else has it all figured out. Well, today, we're going to change that. I'm breaking it all down into a simple, step-by-step guide just for beginners. By the end of this video, you'll have a clear roadmap to start your investing journey with confidence. So grab a notebook and let's demystify investing together. First things first, let's talk about the foundation. Before you invest a single dollar, you need to get your financial house in order. Think of it like building a house. You would start putting up walls without a solid foundation, right? The first piece of foundation is creating a budget. I know. Can sound restrictive, but it's really just a plan for your money. It's about understanding what's coming in and what's going out. You can use a simple spreadsheet or of the many great budgeting apps out there. The goal is to see exactly where your money is going so you can find extra cash to invest, even if it's just a small amount to start. The second part of your foundation is tackling high-interest debt. I'm talking about things like credit card debt, which can have interest rates of 20% or more. The reality is it's almost impossible to outturn that kind of interest with investment returns, especially when you're just starting. The stock market has historically returned around 10% per year on average, but that's not guaranteed. Paying off a credit card with a 20% interest rate, however, is a guaranteed 20% return on your money. So, make a plan to pay down that high-interest debt. It's one of the best financial moves you can make. The final piece of your financial foundation is building an emergency fund. Life is unpredictable. Your car might break down. You could have an unexpected medical bill, or you might face a job loss. An emergency fund is your safety net. It's cash set aside in a high-yield savings account that you can access easily. The general rule of thumb is to have 3 to 6 months worth of essential living expenses saved up. This fund is crucial because it prevents you from having to sell your investments at a bad time to cover an emergency. Once your budget is set, your high-interest debt is under control, and your emergency fund is in place, you are truly ready to start investing. All right, with our foundation solid, let's dive into the core concepts of investing. This is the fun part. First, let's define your why. What are your financial goals? Are you investing for retirement in 30 years, a down payment on a house in 5 years, or maybe for your kids' college education? Your goals and your timeline are incredibly important because they determine your investment strategy and how much risk you can comfortably take. A long-term goal, like retirement, means you can generally afford to take on more risk for potentially higher returns because you have time to recover from any market downturns. A short-term goal requires a more conservative approach to protect your money. So take some time to really think about and write down your goals. Next up is a concept you'll hear a lot: risk tolerance. This is basically your emotional ability to handle the ups and downs of the market. Are you someone who would panic and everything if your portfolio dropped 10%? Or can you stomach the volatility, knowing that historically, the market trends upward over the long run? Be honest with yourself. There's no right or wrong answer. Understanding your risk tolerance helps you choose investments that let you sleep at night. If you're a conservative investor, you might lean more towards bonds. If you have a higher risk tolerance, you might allocate more to stocks. Now, talk about the magic compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world, and for good reason. It's the process of your earnings generating their own earnings. Let me explain. When you invest, your money earns a return. The next year, you earn a return on your original investment plus the return from the previous year. It creates a snowball effect that can grow your wealth exponentially over time. This is why starting early is so powerful. Even small, consistent contributions can grow into a massive sum over several decades thanks to the power of compounding. It's the single biggest reason why time in the market is more important than timing the market. Okay, foundation concepts built. Understood. Now for the practical part. How do you actually start investing? The first step is to open an investment account. For most beginners in the US, this means choosing a brokerage firm Think of a brokerage as a marketplace where you buy and sell investments like stocks and ETFs. There are many great options out there like Fidelity, Charles Schwab, and Vanguard. There are also user-friendly apps like Robinhood and Webull. When choosing a brokerage, look for low or no fees, a user-friendly platform, and good customer support. Once you have your account, you need to decide what type account to open. A standard brokerage account is taxable, but it's flexible and has contribution limits. But for beginners, I highly recommend starting with a retirement account, specifically a Roth IRA. With a Roth IRA, you contribute after-tax dollars, which means your money grows completely tax-free, and you can withdraw it tax-free in retirement. There are contribution limits set by the IRS each year, but for most people, it's an incredible tool for building long-term wealth. If your employer offers a 401k, especially with a company match, that's another fantastic option. A company match is literally free money, so you should contribute enough to get the full match. Now, the big question: what should you actually invest in? As a beginner, it's best to keep it simple. Instead of trying to pick individual winning stocks, which is incredibly difficult even for professionals, I strongly suggest starting with low-cost index funds or exchange-traded funds, also known as ETFs. An S&P 500 index fund, for example, lets you own a tiny piece of the 500 largest companies in the US. This gives you instant diversification. If one or two companies do poorly, it has a minimal impact on your overall portfolio because you're spread across hundreds of others. ETFs like VU or SPY track the S&P 500 and have very low expense ratios, meaning more of your money stays working for you. A great strategy for beginners is dollar cost averaging. This sounds fancy, but it's simple. It means investing a fixed amount of money at regular intervals, say $100 every month, regardless of what the market is doing. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer shares. Over time, this strategy can lower your average cost per share and takes the emotion and guesswork out of trying to time the market. It automates your investing and builds a disciplined habit. You can set up automatic transfers from your bank to your brokerage account to make it even easier. Consistency, the key to long-term success. So let's recap the entire game plan. Step 1. Build your financial foundation. Create a budget, pay off high-interest debt, and establish a 3 to 6 month emergency fund. Step to understand the core concepts. Define your financial goals, determine your risk tolerance, and appreciate the power of compounding. Step 3. Take action. Open an investment account with a reputable brokerage, preferably a tax-advantaged one like a Roth IRA. Step 4. Choose simple, diversified investments like low-cost S&P 500 index funds or ETFs. And finally, Step 5. Be consistent. Use dollar cost averaging to invest regularly and automatically, and play the long game. Investing is a marathon, not a sprint. There will be good years and bad years in the market. The key is to stay the course, not to panic during downturns, and to continue investing consistently. The wealth you build tomorrow is based on the smart decisions and habits you start building today. You don't need to be an expert, and you don't need a lot of money to start. You just need a plan and the discipline to stick with it. You've got this. Thank you so much for watching. I hope this guide has made the world of investing feel a lot more accessible. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more content on personal finance and investing. Let me know in the comments below if you've started your investing journey or what question you still have. I'll see you in the next video.